Oliver, we had second quarter results from the mighty Nestlé today. I guess in the olden days for fund managers, you'd own this if you were worried. It's classically defensive. It would probably underperform in an uptick. Huge business, broadly diversified, many products, many regions. Is there anything from today's results that suggests that anything different is happening in a company like Nestlé?
Well, it's still the big, diversified, defensive company that you describe, but slightly less attractive perhaps for fund managers. The big news today that it's disappointed on the revenue front, the revenue guidance that it gave. It was expecting revenue growth, organic revenue growth of 5 to 6% this year. It now says it'll be 5%. So not a huge difference in percentage terms. It's the lower end of the previous range, but for a company the size of Nestlé, that's quite a big difference. So that disappointment has pushed the shares down today.
And what's the cause of that disappointment?
Well, mainly soft pricing. They've been helped by weaker input prices. Some of their raw materials have got cheaper, but prices they can charge are lower, and particularly in Europe where the economy is so disappointing, so difficult. So that's mainly where the issue is. On volumes, they're doing quite well, but pricing's a bit soft.
And did they say anything about emerging markets? A lot of companies we've been looking at in the last couple of weeks have shown softness there.
Not too bad in emerging markets. They've already disappointed on emerging markets. That was 3 months ago, the first quarter results. So today emerging markets were better, certainly stronger than Europe. The US also is doing very nicely. Things are really picking up there. But it's Europe where the softness is.
Okay, so that's the top line. What about the more important profits and cash flows? How's it doing there?
So on profits, it's doing okay. Profits are up 7% ahead of the growth in revenues. That's because margins improved. Raw material prices are falling as commodity costs have fallen, so that the cost of their goods they buy is falling. That's offset a rise in marketing spend, and what it hopes is that the rise in marketing spend will help sales growth in the second half of the year. But for the moment, it's they've been helped by this lower raw material price, so profits are doing well. On cash flow, not too bad, about level with last year, but they put a lot more into working capital, which is quite a concern.
Okay, and the all-important question on price, what's the valuation look like?
Well, it's 18 times earnings at the moment, which sounds very high, although it's at the lower end of the consumer goods sector. I think that's just a symbol of how defensively minded investors have come, how much they've gone for these very stable, big consumer goods companies. But 18 times earnings isn't particularly cheap for a company that's sort of slightly disappointing.
Just goes to show what you need to pay for quality these days, even in a difficult market. Thank you very much for that update, Oliver.